You know, I sort of liken it to, do you want to be regulated in a Barney Fife sort of style, or do you want to be regulated in a Dirty Harry kind of style? And of course, if you're a company, you'd probably want to opt for the Barney Fife approach rather than the Dirty Harry approach. And I think that, and I don't want to make light of it, but I think that does sort of sum up the concerns that we have about the race to have an optional federal charter. We think is kind of a race to the bottom, that it could, the actual optional part of it could in fact end up being kind of a regulatory arbitrage where if it is lax, then companies will select to be regulated at the federal level. You know, insurance products, as both of us, I think, agree there, and I think Mark made some really eloquent statements early on about the importance of the insurance product in our daily lives. We can't drive a car, we can't open a business, we certainly can't pay for health care services if we don't have good insurance. And but not every insurance product that is developed actually deserves to get into the marketplace. And I'm struck with the battles that we've had in our states over stranger-originated life insurance. These are, we liken to death futures, people gambling on someone's early demise. Instead of life insurance, when you buy a life insurance policy, your company wants you to live for a long time and pay premium. Stranger-originated life insurance is exactly the opposite. The person that buys your life insurance and gives you the cash, a portion of the death benefit up front, is going to benefit from your early demise. You know, products like that have no place in the marketplace, and it's through effective state regulation that we're trying to limit those abuses. So it is through good oversight and good regulation that consumers get the protection that they need. We are moving towards electronic internet capacity. There's no question that the insurance industry is right in the middle of the technological changes that are occurring. Every state has in place the system for electronic rate and form filing, and yet in Kansas we've had to mandate that our companies use it. Now, we've given them a little time to get ready. The system is there. If someone files using the SURF system, the average nationally is a turnaround for those filings in less than 30 days. And it is as simple as entering the information once and then clicking the states that you want those products approved in. So the systems are out there for ease in getting new products to the market. But again, I would just, I guess I would just make the case that that oversight up front protects consumers. It can be, you can get those new products into the market, but you don't get those products into the market that shouldn't be there in the first place. And I guess I would still go back to some of the subprime mortgage crisis, which I do think bank regulators were lax. They weren't looking at those loan portfolios when they were letting people borrow money to buy homes that they could not afford, and then those were packaged into securities and sold to large investors, and they were rated by rating agencies that were not being monitored appropriately. And so that when you look at the subprime mortgage crisis, I do think there was a failure of regulators, a failure in terms of the credit rating agencies, and a failure in terms of banks who allowed people. And you know, I'm not going to say it. There were individuals who knew better, and still, because they could get the loan, went ahead and bought a house that was beyond their means. So I mean, there's blame on both sides. So the system that states have in place, the national system, which I've referred to before, for solvency regulation, has dramatically reduced the number of insolvencies of insurance companies. You know, we're seeing problems in financial services. We're not seeing problems with our insurance companies. State regulators monitor on a regular basis, at least every 5 years, examining the books of those companies, and more often if they think the company is at risk. And our first goal is to go in and work with the company to get them back on sound financial footing. It is in no one's best interest, certainly not the consumer, to have a company become insolvent. So our first line of defense against insolvencies is to, when we suspect that a company might be in financial peril, we get in there and try to get them back on sound financial footing. And how do we do that? A lot of it is through consumer complaints, answering that phone day in and day out. You know, I'm having trouble. A doctor's office will call. I'm having trouble getting claims paid by this insurance company. You know, that could be a red flag. They've got a cash flow issue. That could be a red flag. They've got some financial issues. So it's that, again, that ongoing day-to-day monitoring of companies, answering consumer questions that provides the oversight that is critically important to our consumers, but I think it's also what helps create a healthy environment for our companies. And again, if we've got a problem in insurance regulation in this country, the evidence doesn't bear it out. We've had 2,000 new companies formed since 1995 and $500 billion in surplus, a record right now. To me, that says we've got an insurance marketplace that's working pretty good.